Hi, Professor Kiss here. I want to talk a little bit about liquidity and liability risk. This is related to chapter 19 of the textbook, but instead you're reading my textbook, not the course textbook. So we're concerned about how firms can control liquidity risk, the motives for holding liquid assets, and specific issues associated with liability and liquidity risk management. So depository institutions and insurance companies are exposed to liquidity risk. So I want to also talk a little bit about types of deposits. So you need to have just the right amount of liquidity. If you have too much liquidity, the cost is that you don't earn as much. So a liquid asset is one that can be turned into cash quickly at low transaction costs with little or no loss in principal. So that would be cash, treasury securities, and Fed funds sold, those overnight loans that you could just call back. So you need liquid assets for your daily cash flow and for your operations and your investment flexibility. If you have a great opportunity to make a loan, you want to have some liquid assets to lend. Now, there were regulatory requirements, reserve requirements that banks had to have until 2020, but now the monetary policy says we just need ample reserves. And part of that is because banks have been holding enough reserves at the Fed because the Fed has started paying interest on reserves in 2008. So the securities portfolio is critical in liquidity management. So as I said, we have a number of reasons for why banks held reserves, primarily liquid assets for reserves prior to March 26, 2020, when the reserve requirements changed. So the Fed has said that they can reimpose reserve requirements if there's a reason for doing so, that they can control the federal funds rate directly, both through open market operations and the interest rate it pays on reserves. And so if you want to see what the reserve requirements are, I've got a link here to the Federal Reserve policy, and you can click on that link, and I will do so right now. And here you can read the details about Federal Reserve paying interest on reserves, which right now the rate is 15%. And if we look at monetary policy, you can see the policy for reserve requirement under policy tools. And here are the reserve requirement. And you can see that it is now 0%. It has been that way since March 26th, but they have had different interest rates on different policies, on different types of reserves. So I'm not sure if you saw that, so I need to bring that new share up. It occurred to me you're not seeing. So I am going to share here the Fed's website here on reserves, and I am also going to share here the Fed's website on interest on reserves. So I am now going to go back to a new share and go back to my PowerPoint. So this was the reserve requirements, and it was 10% essentially, but now it is 0. So demand deposits are a source of cheap funding, but there's a high risk of withdrawal. And in class, we're going to go through a practice problem on now accounts. And we're going to talk about something called implicit interest, which is not charging the depositor as much as fees as a cost to bank to provide the service. This will be similar to homework that you have due on November 15th. So this is the problem. We'll work through it in class on Wednesday, November 3rd. So as I said before, there is a trade-off between the funding risk and the funding costs. And what are some of your sources of funding? Well, one is repurchase agreements, which the jargon is repos. They're essentially collateralized Fed funds. You buy assets and then repurchase them. And this is what the Fed does. Then they have reverse repos. And then demand deposits are cheap but risky funds, which will leave. Now accounts do have a minimum balance that must be kept, and there is a small amount of interest being paid. If there is interest being paid on your checking account, it is technically a now account. Money market deposit accounts used to have a transaction limit, no more. Retail CDs are those with face values under $100,000 and maturities from 2 weeks to 8 years, and wholesale CDs are over $100,000. They are sellable in the secondary market. Now, I want to also mention a couple of other accounts, passbook savings accounts, which are not checkable, but the bank can withdraw, delay withdrawals for as long as a month. A statement savings account is a savings account in which the transactions are confirmed periodically by a bank statement. Most regular savings accounts in use today are statement savings accounts, not passbook savings accounts. And money market deposits are somewhat less liquid than demand deposits and now accounts because there was a minimum balance requirement. And I've talked already about the wholesale CDs and the retail CDs. Now, the Fed funds market is the interbank market for reserves. And there's no real reason to use that here. You don't need to borrow, but the rates used to be highly variable prior to this lagged reserved accounting. But that was all related to reserve requirements. And the rest of the chapter will talk about reserve requirements. And the federal funds is that interbank market for reserves. And most of the Fed funds are maturities of 1 day overnight. And I've shown you here information about the Federal Reserve. And I mentioned that the repurchase agreements are essentially collateralized Fed funds. They backed by government securities or agency mortgage-backed securities, FEDIs and Frannies. They can be a little bit more difficult to arrange than simple Fed funds loans. Other types of borrowings are bankers' acceptances, commercial paper, medium-term notes. And as I said, the rest of this chapter is talking about reserves, and you could read my PowerPoints on your own, but we are not going to talk about it since the Fed no longer requires the banks to hold reserves. Now, I want to also do a new share for a minute and talk about the discount window. So let's go back and look at monetary policy tools. So I want to make sure I'm sharing this new share. I'm here. Yes. Okay, I'm sharing this with you. Monetary policy tools. And I want to talk about the discount window and the discount rate. This is the place where the Federal Reserve lends to depository institutions and sometimes at other institutions. The discount rate is the interest rate charged to commercial banks on loans they receive from the regional Federal Reserve Bank's lending facility known as the discount window. There are 3 types of credit: primary credit, secondary credit, and seasonal credit. These loans are all secured, and the discount rate on secondary credit is higher than that of primary credit. These are banks that have have CAMELS ratings of 3, 4, 5. They are not able to borrow at if they're 4 and 5, they have to pay a higher rate to borrow. Now, if you want to see here the different rates here, we can go to the website for the discount window, and you can see that primary credit, the rate is 0.25%, which is above the interest rate that the Fed is paying on reserves. Seasonal credit lends primarily to banks that are agricultural firm banks, and that's a tenth of a percent. So the primary credit's 0.25%, and the secondary credit is 0.75%, and the Fed funds rate is 0.25%. So we will talk about these things in class. I just thought rather than me lecture, let me make a video for you to watch. Thank you very much for watching.